Yeah, hi everyone. Thanks for joining me here today. I'm Mark Phillips. I'm the founder and principal at Harvested Financial, and I'm also the creator of the Tape Report. And that's what we're going to be looking at today, specifically the expensive calls report. But before we do that, I want to remind everyone that while I am a financial advisor, I'm not your financial advisor. Unless we have a specific contract, none of this constitutes investment advice or recommendation to buy and sell securities. It's entirely for informational purposes, and we're here to discuss the software and the options market, not make trade recommendations. If you have any questions about that, please visit my website at harvestedfinancial.com and you'll find the terms and conditions at the bottom there. So without further ado, now let's dig into the expensive calls report. When you log into the TAPE.Report, you'll be asked to log in with your Google or Google Workspace name, and we use that so we don't have to store any passwords here. But once you cross that authentication, you'll arrive at our homepage. And here you'll find your login name, as well as a quick start guide on the lower right-hand corner that can help with any screen adjustments or some of the navigation questions you might have on your first login. You can also check out more tutorials. We have expensive puts, fixed delta spreads, and tons more coming out there. And finally, sign up will link to any additional services or dashboards that you're interested in on our homepage. So now we can go ahead and take a look at the expensive calls report. I'll navigate on the left-hand side of the page. If that doesn't show, you can expand it with that arrow. So we'll go to expensive calls. One of the first things I want to check is what the update time is. So I can see here last update on November 6th at 11:04. It's 11:11 right now. So we know this is some of the latest data that's out there. Every 15 minutes, it goes out and refreshes market data. That's kind of the fastest snapshot we're allowed to provide, and analyzes and scans the market for these expensive puts. So now that we know we have the latest data, if we don't, again, we can hit that refresh data button in the lower left-hand corner. Let's talk about how this goes out and looks for expensive calls. So the first step, as always with market data and analyzing the options market, is making sure you have good quality data. So the first thing we do with the data, once we get all the snapshots, is we throw out any values that might be bunk. We look for a fair value. That's that FV column that you can see here. So we look for a fair value that might be outside the current markets. We throw away things like corporate actions or other sort of curious non-standard deliverables. There's a little bit of a threshold on that fair value. So we give plus or minus a nickel outside the bid or ask. But that fair value is also intended to be a smoothed curve. So it looks not just at that specific series to come up with a fair value, but it looks across the entire options curve to come up with what that fair value should be. So it's both consistent within the same month and across other months. So that fair value is an important aspect, and it will also be important as you're looking at execution. Especially in wider markets, if even just looking at this top example in EBIX, if that's a dime at 20 cents wide, normally we'd say midpoint is fair value, but according to the curve here, 13 cents is closer to fair value. So don't expect to get executed at 15 or 16 cents if this is truly worth 13 cents. So there are a couple different filters that you can use to approach the expensive calls report. Very similar to the expensive put report. Encourage you to take a look at that one also. But we can look at the delta range, we can look at the days to expiration, and we can look at the dollar price. So the delta, we have three different buckets here: 0 to 15, 15 to 30, 30 to 45. This is good for sort of parameterizing how aggressive you want your strategy to be. Are you looking for selling meatier at the money calls in that 30 to 45 delta range? Or are you looking for selling further out of the money in that 0 to 15? The lower the delta, generally the lower probability that you'll get exercised on that call. But the income that's earned from those higher delta calls might offset some of that. So really it's a question of what type of strategy you're looking for. Days to expiration, a similar type of question. If we're looking for more near-term calls, those are going to have higher premiums per day, but you're also going to have a little bit more of a choppy experience. That said, you get to turn that over relatively frequently. Further out, you're less likely to, you have a number of days for that strategy to wear out, but the premiums aren't necessarily as fat if you're really looking for an income generation strategy. Finally, we can target different dollar prices. So we can look at low dollar stocks. You can create a basket of different expensive calls. That's really helpful if you want to diversify kind of your bets across this. or if you're looking for some higher priced names because you want bigger numbers, bigger premium collection, or if you're looking for specific names in general, the highest priced index ones, for example, will show up. So thinking about different strategies for the expensive calls report, I've mentioned some of the different ways we might go at it. You've heard me say sell probably. Often that's people's reaction when we see expensive. That indicates that something's overpriced or that it's out of range for what it should be. Really the main filter on this is just how much that call is priced relative to the stock price. So after we scrub all the market data, we just look for relatively expensive calls using that simple metric, and then add a couple different filters to help answer that question. Is this a call I want to sell because I think it's priced relatively high? Or maybe it might be a buy opportunity. A lot of these audits aren't necessarily a single solution idea generator. They're going to point to things that are funky. And with some of the other research and some of the other dashboards, you can really contextualize what's going on. But here we have a couple data points also to help decide whether that call really is expensive. So, we're looking at the bid and the ask on EBIX here at this 11:10. That's this Friday's 9 strike expiration. So with stock trading $6.06, the $9 strike has a fair value of about 13 cents. So that gives us an enormous amount of upside. Often when we're talking about expensive calls, you can, of course, sell calls, naked calls, if you have the right options permission. I generally don't like that. I think naked option selling isn't always the best risk managed way to take advantage of what's going on in the options markets. So another way you could think about this is as a way to leg into a spread. So you could sell that 9 strike to buy something further. You could even get long the call spread to the extent that you thought the way upside was more skewed. But another really common strategy, other than using this as a jumping off point for spreads, would be a buy right. And so the reason I suggest buy right and some of these factors here is that with stock trading $6.06 up to the 9 strike, you have quite a big upside cap. You get almost 50% gain. So that's what that upside cap means. If you sold that call and bought that stock, you could gain 48% in your stock position before that call was exercised. So generally with these most expensive ones, they're going to be high priced, out of the money, or with the 0 to 15 delta, very far out of the money. And as you can see, some of these upside caps are pretty fat here. So that's one way to question, how expensive might this call be relative to where stock's currently trading. We can also think about it in terms of volatility pricing. What's the implied volatility of that call? And then compare that to maybe the historical volatilities. So with an implied volatility of 310 for EBIX, that's enormous. The SPY implied volatility out a week is around 16 right now. So 310% implied volatility is what's making this very expensive. And we can then compare it to these two different historical volatilities. I use the 10-day figure in here because most of these strategies tend to be fairly short term. An important thing when you're analyzing option strategies is making sure your data aligns across time frames. So we want to look at a historical volatility on 10 days, relatively short, if we're making relatively short-term trading decisions. So the historical vol has only been, on a close-to-close basis, that is comparing the close price every day, about 104. And using the Parkinson's method, it's an intraday method. We take the high and lows within the day. That volatility is about 94. The main difference between those two being Parkinson's does not capture after hours movements in the stock, and we know stocks do move a little bit, but it does capture a little bit more of that intraday range, which might matter for different opportunities to close and open positions like this even. So considering implied vol and historical vol in context, helps us say, why is this implied vol pricing so high if it has only moved so much? One answer to that might be earnings. There's earnings tomorrow actually in EBIX. So that's obviously going to be a very important event. We expect a lot more variance to happen around then. So some traders like to trade into earnings. Some traders don't necessarily like to trade into earnings. It's really a question of style. The fat premiums are often there to offset relatively large moves. So it's really a balance of what type of edge you're looking to gain in the marketplace. This call percent of stock column, that was what I mentioned as being the main filter acts for this whole report. So it's automatically sorted by the biggest ones. And We then look at the delta range. So we're looking at relatively small deltas. And the final columns that are interesting would be the at the money strike and at the money straddle. So in these, one of the ways to think about how expensive or far away from the current price that call is that we're analyzing would be, where's the straddle? Are we within or outside of that straddle range? So EBIX being a $6.20 stock, that at the money strike is 650, the straddle's 210. So add 210 to 650, we get about 860. We see that our 9 strike call is just outside of that. So that strike and straddle range are important there for kind of contextualizing what the where that call is relative to how much at the money volatility is. So there are a lot of different strategies you can use expensive calls for. You can use it to identify buy rate opportunities. You can use it to identify the expensive leg of a strike by selling the expensive strike and maybe buying something slightly less expensive below it or above it in a defined risk vertical. To understand where this expensive call fits into the whole context, that's where the full tape report and all those dashboards come in. So we'd encourage you to look at things like stable skew or VRP, or even just analyze some of the spread indicators to understand what really is expensive. As an audit, it's a great jumping off point for finding tons of different trading strategies. So thanks so much for joining me. If you like this video, please subscribe, please hit the like button, and most of all, share it with friends, because the more people that are trading and learning about options, the better the markets get for all of us. So thank you again. Please check out my website at harvestedfinancial.com, and you can log in anytime at TheTape.Report for a free preview of all of our indicators. Thanks again, and happy trading.